to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Mark Palmer, Managing Director and FinTech Analyst at BTIG. Mark, it's great to have you with us. Welcome to Trade Talks.
Thanks for having me.
All right, you got it. And amid the FinTech equity volatility, do you believe that investors seeking opportunities as 2022 begins should consider buying the dip?
Oh, absolutely. I think that this is an environment in which there are a tremendous number of opportunities, particularly with fundamentally sound companies with long-term secular tailwinds. What am I talking about? I'm talking about payment companies where adoption of their particular FinTech application is in the early innings, both in the US and globally. And an example of that is Square, which is now known as Block, of course. If you look at the adoption of the Cash App, the growth rate has been tremendous. The reality is that the runway is tremendous as well. And so as Block continues to add functionality to what is becoming a super app, we believe it's going to continue to gain traction both in the US and increasingly on the international stage. Right now, Block has only about 15% of its revenues in the US, enormous international opportunity.
And you believe that 2022 is poised to be a year just as eventful for the still nascent industry, if not more so. What else are you going to be watching in terms of secular trends?
Yeah, I think one of the things that we pick up on is the fact that among small businesses, medium-sized businesses, there's still a tremendous amount of paper that's being used to facilitate various functions. And so we think that there's going to be a tremendous opportunity among integrated payment companies to come in with a package of software and payments and effectively pick up a lot of those B2B payments, which are still being handled by paper checks, by paper invoices. It's remarkable that in 2021 going into 2022 that's the case, but it is the reality. It creates a tremendous opportunity, particularly for a number of these integrated payment companies. Who am I talking about? The likes of Repay, RPAY, Paya, PAYA. All of these stocks are down significantly. A lot of that is just concern about the macroeconomic environment, which is definitely a concern. But we believe that the impact of the near-term macro is very much baked in. The longer-term secular trend is very much intact.
And Mark, is it possible that digital platforms will look to build their own version of super apps? I mean, super apps really are what they're called.
I think we're seeing it. We're seeing it in real time. A great example of this is the fact that you have so many different platforms that are buying buy now, pay later companies. Example of that is Block buying Afterpay. You saw PayPal first build its own version of buy now, pay later, and then tap M&A to expand beyond that. We look at buy now, pay later as just another function that's going to be added to these various super apps. As this consolidation continues, we're going to end up with a handful of super apps that are remaining. We believe Block is going to be one of those. PayPal is going to be another. You look out and you see the potential to see Stripe or Shopify or others. The upshot is, though, that there are certain firms that have advantages there. One of the big ones is having a bank, and that's where Block stands out, because Block, by having a bank, has access to long-term, lower cost of capital because it has low-cost deposit funding. Over time, we think that's going to be determinative.
Right. Well, Mark, how concerned are you about buy now, pay later? It is starting to come under some scrutiny, and I personally believe for some good reasons.
Mm-hmm. Well, I think it's very different than a lot of the other types of applications that do come under scrutiny, particularly lending, where you can see interest rates, APYs that can be 50% or more. That's a very real issue. Now, with regard to buy now, pay later, the biggest issue is whether individuals are overextending themselves. The reality, though, is that these are short-term loans. They're typically 4 weeks in tenor. It could be a little bit longer than that. But the upshot is that if somebody's going to be getting themselves into trouble, they're going to be doing it in a very short period of time. And it's not one of these things where somebody can ramp up credit cards to the nth degree. Frankly, between those two issues, I think that extended credit card debt is a much bigger problem, net. And the reality is that buy now, pay later is giving access to credit to those who otherwise wouldn't have it. They don't have access to credit cards. They may not have a bank account. Here, they can take advantage of what is essentially installment lending.
Right. That is a good point. Mark, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.